The Federal Reserve has decided to keep interest rates unchanged, marking a significant moment in its ongoing efforts to manage the economy. This decision comes after a series of aggressive rate hikes aimed at curbing the rising inflation that has been affecting the economy for months. These rate hikes were part of a broader strategy to control inflation, which had reached levels not seen in decades. By increasing the cost of borrowing, the Fed hoped to slow down economic activity and bring prices under control. The decision to pause was widely anticipated by the market, with many analysts predicting that the Fed would take a step back to assess the impact of its previous actions. This pause provides a moment of relief for investors who have been closely monitoring the Fed's moves. Investors are now assessing the implications for the economy, trying to understand how this pause might affect future growth and stability. The Fed's decision is seen as a cautious approach, allowing them to gather more data before making further moves. This pause allows the Fed to evaluate the impact of previous rate increases on various sectors of the economy, including housing, employment, and consumer spending. It also provides an opportunity to see if inflationary pressures are easing. It also gives them time to analyze incoming economic data, such as employment figures, consumer spending, and global economic trends. This data will be crucial in determining the Fed's next steps. The Fed remains committed to bringing inflation down to its 2% target, a goal that is essential for long-term economic stability. They will continue to monitor the situation closely and adjust their policies as needed to achieve this objective. U.S. Treasury yields showed little change after the Fed's announcement. The 10-year Treasury yield dipped slightly. The 2-year Treasury yield also moved marginally lower. These yields are closely watched indicators of investor sentiment. The muted reaction suggests that the market had already priced in the Fed's decision. Investors are now looking for clues about the Fed's future moves. Upcoming economic data will be crucial in shaping those expectations. The Fed's decision to hold rates steady was driven by several factors. Inflation, while moderating, remains above the central bank's target. The labor market continues to show strength with low unemployment. Inflation remains somewhat elevated, the Fed noted in its statement. They acknowledged the solid labor market conditions. The Fed wants to see further progress on inflation before considering any rate cuts. Section 4. Market reaction. Expectations met. Focus shifts to data. The market reaction to the Fed's decision was largely muted. Investors and traders had already priced in the likelihood of the Federal Reserve maintaining its current stance on interest rates. This lack of surprise led to a relatively calm trading session. This indicates that the announcement was in line with expectations. Analysts had widely predicted that the Fed would hold off on any rate hikes. Given the current economic indicators and market conditions, investors had anticipated the Fed to hit the pause button on rate hikes. This anticipation was based on recent economic data that suggested a need for caution in further tightening monetary policy. Attention now turns to upcoming economic data releases. These reports will be crucial in determining the Fed's next steps, and will be closely watched by market participants. These releases will provide further insights into the health of the U.S. economy. Key metrics such as employment rates, consumer spending, and manufacturing output will be under the microscope. Of particular interest are the upcoming GDP figures and inflation readings. These indicators will help gauge whether the economy is growing at a sustainable pace, and if inflationary pressures are under control. Section 5. Looking ahead. Key economic indicators on the horizon. Several important economic indicators are due out in the coming days. These indicators will provide valuable insights into the current state and future direction of the economy. Investors, policymakers, and analysts will be paying close attention to these reports to gauge economic health and make informed decisions. The fourth quarter 2024 GDP report will shed light on economic growth. This report is crucial as it reflects the overall economic activity and helps in understanding whether the economy is expanding or contracting. A strong GDP growth rate can signal a robust economy, while a weaker rate might indicate economic challenges. The Personal Consumption Expenditures, or PCE index, the Fed's preferred inflation gauge, will be closely watched. This index measures the changes in the price of goods and services consumed by households and is a key indicator of inflation trends. Rising PCE can indicate increasing inflationary pressures, while a stable or declining PCE suggests controlled inflation. These data points will be crucial for the Fed's future decisions. The Federal Reserve relies on such economic indicators to set monetary policy, including interest rates. Depending on the data, the Fed might decide to raise, lower, or maintain interest rates to achieve its dual mandate of maximum employment and stable prices. Strong economic data could prompt the Fed to maintain its current stance. If the data indicates a healthy economy with controlled inflation, the Fed might continue with its existing policies, ensuring that the economic growth remains steady without overheating. Weaker data, particularly on the inflation front, might increase the likelihood of rate cuts later in the year. If the indicators show signs of economic slowdown or rising inflation, the Fed might consider cutting rates to stimulate economic activity and control inflationary pressures.